Recessions are a topic of concern for investors and are always on their minds. Unfortunately, these periods are inevitable, and eventually the economy shrinks, causing asset prices and the stock market to plummet. During such times, it is common to focus on minimizing losses, but doing so incorrectly can erase years of progress in your portfolio. However, it is possible to not only survive but thrive during recessions by making significant adjustments to your investment strategy. By doing things differently than you would during a period of economic growth, your portfolio can continue to grow, even in a recession. Whether you are trying to protect your retirement portfolio or are new to investing, there are 6 essential factors that will help you weather these challenging times and put you ahead of the game. First, it is important to understand what a recession is. There is no clear-cut definition that everyone agrees on, but generally, a recession is a significant and prolonged decline in economic activity. It is typically characterized by a decline in gross domestic product for 2 consecutive quarters or more. Regulatory bodies, such as the National Bureau of Economic Research in the United States, officially declare the beginning and end of recessions. The process of declaring a recession can be tricky, as the National Bureau of Economic Research uses lagging indicators and wants to avoid false positives. This means that a recession could have been ongoing for months before it was officially declared. It is important to take steps to protect oneself even before an official announcement. First things first. During a recession, risk tolerances change, and investing should be approached from a different viewpoint than during periods of economic expansion. It is essential to make sure that one's emergency savings fund is well stocked with at least 3 to 6 months' worth of living expenses covered in advance. Short-term trading is too risky during a recession, so a long-term approach is recommended. Number 2, cash is often an underappreciated asset class, but during a recession, it becomes king. Cash and its equivalents are highly liquid and allow one to take advantage of opportunities and get into positions that might have otherwise been missed due to a lack of capital. However, it is risky to allocate a large portion of one's portfolio to cash. A better approach is to allocate a small portion of the portfolio to cash and use dollar cost averaging to combat the risks of holding large sums of cash. Dollar cost averaging is a technique for investing in securities such as stocks or mutual funds. Instead of investing a lump sum of money all at once, an investor can divide their investment into equal amounts and invest them at regular intervals such as monthly, weekly, or daily. For example, an investor may decide to invest $1,000 in a stock every month for a year, regardless of whether the stock's price is high or low. The benefit of dollar cost averaging is that it helps to reduce the impact of market volatility on an investor's portfolio. When an investor invests a lump sum of money all at once, they run the risk of investing at a high point in the market cycle only to see the value of their investment decline shortly thereafter. With dollar cost averaging, the investor is buying shares at different prices over time, so the impact of market fluctuations is spread out over a longer period. Dollar cost averaging also removes the need for an investor to make market timing decisions, which can be difficult to get right. By investing a fixed amount at regular intervals, the investor is taking a disciplined approach to investing and is less likely to make emotional decisions based on short-term market movements. One potential downside of dollar cost averaging is that it can lead to missed opportunities for gains. If an investor is investing a fixed amount at regular intervals, they may miss out on the opportunity to invest a larger amount when the market is down and stocks are cheap. However, by investing a fixed amount over time, the investor is still able to take advantage of the long-term growth potential of the market. Number 3, stay away from these types of stocks. When the economy is bad, you don't want to take on any extra risks. Just as important as knowing what to move toward is knowing what to avoid. The truth is that some businesses are not good places to put your money during a recession because of how they operate. On the other hand, in the past, some industries have shown that they can survive a recession, but we'll talk about that in a minute. Then, what kinds of stocks should you avoid? Avoid companies with a lot of debt. During a recession, it can be hard for companies with a lot of debt on their balance sheets to pay off that debt, especially if their sales drop. In this case, they might have to cut costs by laying off workers or putting less money into growth projects, which can cause stock prices to drop even more. Avoid companies in the manufacturing, construction, or auto industries. During a recession, demand for these companies' goods and services is likely to go down, which can hurt their sales and profits. Avoid speculative or growth stocks. These are shares of companies that aren't making money yet, but whose growth is expected to be fast in the future. During a recession, investors might be less willing to take risks, which could cause the prices of these stocks to go down. Avoid tech companies. Even though most people think tech companies can handle economic downturns better, they can still be at risk if their business models depend heavily on advertising or consumer spending. Also, if the market as a whole goes down, investors might be less willing to pay high multiples for tech stocks, which could cause their prices to go down. During a recession, not all of these types of businesses will necessarily do badly. Some may be able to handle economic storms better than others because they have strong balance sheets, economic moats, multiple sources of income, or defensive business models. To put it in plain English, you don't have to get out of these sectors completely, but you should be very careful about making new investments during a recession. Number 4. Stocks that tend to do well in a recession. In a recession, investors tend to put their money into defensive stocks, which are companies that are less affected by changes in the business cycle and can still make steady profits and revenue even when the economy is down. In the stock market of today, many of these shares can be traded on platforms that don't charge any fees and have advanced tools and research capabilities. Keep in mind that not every company in these defensive industries will do well during a recession. Some businesses may have a lot of debt or be open to risks that could hurt them even when the economy is bad. Before making any investment decisions, it is important to do your own research and analysis. During a recession, investments that tend to do well are utilities. These are companies that provide services that everyone needs, like electricity, gas, and water. No matter how the economy is doing, they tend to have steady income and cash flow, which makes them less likely to fail when the economy goes down. Another investment that tends to do well in a recession is consumer staples, which include things like food, drinks, cleaning supplies, and personal care items. Companies that make and sell these goods tend to have steady sales and income, which makes them good stocks to own during a recession. The healthcare sector is another investment option. Pharmaceutical, biotechnology, and medical device companies tend to have stable demand for their products and services no matter how the economy is doing. Also, spending on healthcare is often seen as a non-discretionary expense, which can help protect against a recession. During a recession, people are more likely to buy insurance to protect their assets and income, which is good for insurance companies. Also, insurance companies tend to put their money into fixed income securities, which can give them a steady source of income when the economy is uncertain. During times of economic uncertainty, precious metals like gold and silver are often thought of as safe investments. During recessions, they tend to keep their value or even go up in value, which makes them a popular choice for investors who want a safe investment. During a recession, real estate can be a safe investment, especially if it brings in steady rental income. Also, some types of real estate investments, like real estate investment trusts, can help you spread your risk and protect you from inflation. The law requires real estate investment trusts to distribute 90% of their taxable income as dividends. Since we've already talked about dividends, we should also talk about dividend stocks. Companies that have consistently paid dividends for a long time are often called blue chip stocks. These companies have strong balance sheets and tend to do well during recessions. Here, it's important to think about their current dividend yield, how much their dividends have grown over the years, and how well their business is doing right now. Investing in dividend stocks is a simple way to make money even when the market is going down or staying the same. Investors still get all the benefits of capital appreciation. Number 5. Look into bonds and uncorrelated assets. Diversifying your portfolio with uncorrelated assets can help mitigate overall risk. These assets have a low or negative correlation with the stock market's performance, providing a hedge against market volatility and economic uncertainty. Consider the following examples. Investment-grade bonds. These bonds are issued by high credit-rated companies or governments, providing stable income during market volatility. Insurance-linked securities. These investments are tied to insurance events, such as natural disasters, making them a source of uncorrelated returns due to their reliance on global climate policies instead of the stock market. Carbon credits. These environmental assets represent the right to emit a certain amount of greenhouse gases, offering uncorrelated returns based on global climate policies rather than the stock market. Commodities, gold, oil, and agriculture products can offer uncorrelated returns due to supply and demand factors. Other alternative investments, private equity, hedge funds, and venture capital funds can provide access to strategies and asset classes not available through traditional stocks and bonds. It's important to remember that while uncorrelated assets can offer diversification benefits, they may not always perform well, and some may carry additional risks such as liquidity or regulatory risk. Therefore, it's best to limit investments in uncorrelated assets to a small percentage of your overall portfolio. Number 6. If your risk tolerance can handle it, consider options trading only. If you know what you're doing. Our 6th point on the list may come as a surprise. Options, being derivatives, are inherently risky. However, despite their volatility, options trading can present a unique opportunity to profit from falling stock prices. Specifically, we're interested in put options, which allow the buyer to sell a stock at a set price on or before a specified date. For example, an investor who expects a recession might purchase put options on a stock currently priced at $110 with a strike price of $100 and an expiration date 6 months away. If the stock price drops to $90 by the expiration date, the investor can exercise the put option and sell the stock at the higher strike price, making a profit. Of course, this strategy requires a high risk tolerance and a good understanding of how options work. But beginner-friendly trading strategies and risk management tools like stop-loss orders and sell targets can help make options trading less daunting. Moreover, put options are not just used for profit-taking. Investors can also use them as a hedge against future losses, protecting themselves from potential damage. In conclusion, during a recession, the times are tough, frightening, and uncertain, and it is crucial to weather the storm for the sake of your financial security and that of your loved ones. However, if you make wise investment decisions during these challenging times, you can not only mitigate some of the damage, but also prosper in such conditions. Unfortunately, none of us is immune to a recession, and it is essential to know how to respond during these pivotal moments. We hope that we have assisted you in this regard. Thank you for watching this video and learning about how to navigate recessions. Remember, these are challenging times, but with the right approach, you can come out on top. Don't forget to like this video and subscribe to our channel for more helpful tips on personal finance and investment. If you have any questions or comments, please leave them below and we'll get back to you as soon as possible. Keep persevering, stay positive, and we'll see you in the next video.